Picture this. You're gliding through the sky in a luxurious private jet, sipping champagne and leaving the crowded airports behind. But here's the best part, you're not just living the high life, you're making a genius financial move. While others see private jets as a billionaire's toy, you see a golden tax-saving opportunity. Welcome to fractional jet ownership, where smart business meets first-class comfort. Buckle up, because we're about to uncover how flying private can actually save you money. Depreciation deductions. Accelerate your tax savings. Owning a slice of a private jet isn't just about skipping airport security lines and sipping champagne at 40,000 feet. It's also a smart financial play. One of the biggest perks of fractional jet ownership is the ability to write off a significant portion of your investment through depreciation deductions. The IRS allows jet owners to depreciate their aircraft investment over 5 years, meaning each year, a chunk of the jet's cost can be deducted from your taxable income. It's like getting rewarded for flying in style. But here's where things get even better. Thanks to the Tax Cuts and Jobs Act of 2017, fractional jet owners have been able to take advantage of 100% bonus depreciation, which means you could deduct the entire cost of your share in the first year instead of spreading it out. Imagine slashing your tax bill significantly while enjoying private jet privileges. Talk about a win-win. However, there's a catch. This golden tax break is on a countdown clock, phasing out year by year. While it stood at 100% until the end of 2022, it dropped to 80% in 2023 and continues shrinking 60% in 2024, 40% in 2025, and so on until it vanishes in 2027. What does this mean for you? If you're even remotely considering fractional jet ownership, now is the time to make your move. The sooner you invest, the more you stand to save in taxes. Waiting too long could mean leaving tens or even hundreds of thousands of dollars in tax savings on the table. So, if you love the idea of flying like a VIP while making a financially strategic decision, this is your moment to act before this lucrative tax break disappears into thin air. Business expense deductions. More than just a joyride. Flying private isn't just about avoiding long security lines or getting the best in-flight snacks. It can also be a powerful financial move if you use your fractional jet share for business purposes. The IRS allows businesses to deduct a wide range of expenses tied to private jet travel, making it a surprisingly tax-efficient investment. Costs like monthly management fees, occupied hourly fees, fuel, maintenance, insurance, and even crew salaries can all be written off, significantly reducing taxable income. This means your high-flying lifestyle isn't just a luxury, it's a strategic way to optimize your finances. Think of it like this. If a company needs to transport executives across multiple cities for client meetings, they could rack up a hefty bill, say $30,000 in one trip, covering fuel, catering for in-flight business discussions, and additional positioning costs. Now, if that company is in the 35% tax bracket, this trip could result in a tax savings of $10,500 just by properly documenting its business purpose. That's not just first-class convenience, that's first-class financial planning. But here's the catch, you must keep detailed records. The IRS won't just take your word for it when you claim deductions. To ensure compliance and avoid penalties, every flight needs to be properly documented. This includes maintaining flight logs, expense reports, passenger lists, and business justifications for each trip. A simple oversight could turn your tax-saving jet ride into an IRS headache, so meticulous bookkeeping is key. Ultimately, fractional jet ownership isn't just about traveling in style, it's a way to combine efficiency with smart tax planning. By properly structuring your business-related flights and keeping your records airtight, you're not just getting from point A to B in comfort. You're also making every mile count toward lowering your tax bill. So, the next time you board your private jet, remember, it's not just a luxury, it's an investment that works just as hard as you do. Sales tax advantages. Navigating the state maze. Owning a slice of a private jet comes with undeniable perks. But if you're not careful, sales tax can take a big bite out of your wallet. Depending on where you purchase your fractional jet share, you could be looking at a hefty tax bill, or, with the right strategy, paying little to no sales tax at all. Some states understand that private aviation plays a key role in business efficiency, so they offer exemptions or reduced tax rates for aircraft used in interstate commerce or for business purposes. With proper planning, you can structure your purchase to take advantage of these tax-friendly policies and keep more money in your pocket. One of the smartest ways to reduce sales tax liability is by purchasing your fractional jet share through a leasing structure or setting up ownership in a tax-friendly jurisdiction like Oregon, Montana, or Delaware states that don't charge sales tax on aircraft. Additionally, some states offer flyaway exemptions, which allow buyers to avoid sales tax if the aircraft is flown out of the purchasing state within a specified time. This means that, with the right planning, you can legally sidestep thousands or even hundreds of thousands of dollars in taxes. However, tax laws around private aviation can be complicated, and missing a small detail could cost you big time. This is why consulting an aviation tax professional is a smart move. They can guide you through the best strategies to minimize tax exposure while ensuring compliance with all regulations. In short, when it comes to private jets, the sky isn't the limit your tax savings are. Personal use considerations. The fun comes at a price. Flying on a private jet for personal trips sounds like a dream, but when it comes to taxes, the IRS isn't exactly in a generous mood. While business-related travel offers substantial tax breaks, personal use of your fractional jet share comes with strict limitations. If your company owns the jet share and allows you to use it for personal travel, the IRS may consider it taxable income, meaning you could owe taxes on the fair market value of the flight. To calculate this, the IRS uses the standard industry fare level rates, which take factors like flight distance and aircraft type into account, ensuring Uncle Sam gets his cut. However, there are ways to make your jet work for you. To maximize tax benefits, many fractional jet owners strategically mix business with pleasure. For example, combining client meetings with a weekend getaway or inviting business partners along for a trip can increase the percentage of qualifying business use and make more expenses deductible. Another smart move: leasing your aircraft share to other business users when you're not flying, ensuring your jet stays active under business-related operations. The key is careful planning and documentation, so you can enjoy private jet perks while keeping tax liabilities under control. After all, flying in luxury is great, but saving money while doing it, even better. Ownership structure. Choose wisely. When it comes to fractional jet ownership, how you structure your ownership can make a world of difference in your tax situation. Many savvy owners choose to hold their share through a business entity, such as an LLC or corporation, which not only simplifies the process of claiming deductions, but also provides liability protection. Structuring ownership this way ensures that the aircraft is legally tied to business activities, making it easier to justify tax benefits while shielding personal assets from potential risks. However, the wrong setup can backfire. Placing the aircraft in a separate legal entity might trigger federal excise taxes, which could add unnecessary costs instead of savings. Additionally, failing to align your structure with IRS regulations could jeopardize deductions and lead to audits. That's why working with an aviation tax professional is crucial. They can guide you through the complexities of ownership, ensuring you get the maximum tax advantages while staying compliant. So, while flying private may be seamless, your financial structure needs to be just as smooth to keep your tax savings soaring high. And there you have it. Flying private isn't just luxury, it's strategy. If you enjoyed this deep dive into the world of fractional jet ownership, don't forget to like this video, subscribe for more high-flying insights, and hit that bell icon so you never miss a takeoff. Until next time, stay sharp, stay savvy, and keep soaring to success.